The Fed is trapped, and silver just flashed the kind of signal that only appears when the policy story stops working and the market starts forcing outcomes. This move isn't emotion, it's math. And the louder the official messaging gets, data dependent, soft landing, boy, everything is under control. The more silver keeps doing the one thing you don't get in a calm, well-managed regime, it rips through ceilings as if price discovery is being pulled forward. That's the conflict. One side needs the public to believe inflation is contained, the currency is stable, and liquidity is fine. The other side is the market, and it doesn't negotiate, it only clears. And the hidden detail the mainstream keeps missing is that silver doesn't have to become everyone's favorite metal to do this. Silver only needs the plumbing to tighten for a short window, the calendar to force positioning, and the paper market to realize it can't bully the physical market on demand. Because when that happens, you don't get a slow trend, you get a lurch, you get air pockets, you get forced buying, and if one level breaks, the math changes. Here's the part you need to lock in before we touch any forecasts. Silver is not just a precious metal, it's a liver, it's a stress sensor, it's the weird hybrid asset that reacts like a store of value when currencies wobble, and like an industrial input when supply chains and procurement panic show up. That dual identity is exactly why this move is so revealing. Because if this was just inflation, gold would be the cleaner tell. If this was just growth, copper would be the cleaner tell. When silver is the one acting possessed, it's usually because multiple forces are stacking at once, and the market is front-running the central bank's loss of degrees of freedom. And that is what Fed trapped actually means in real markets. Not that the Fed wants something and can say it, but that the Fed has fewer and fewer choices that cause immediate collateral damage somewhere else. If it eases, it risks relighting the inflation narrative and weakening the currency at the margin, especially when the world is already hedging currency risk. If it stays tight, it risks breaking funding-sensitive corners of the system, choking credit, and turning disinflation into demand destruction. Either way, volatility becomes the policy transmission, and silver thrives in volatility when the plumbing tightens. That's where the real pressure starts. Look at what just happened right now, this week, this month. Silver didn't grind upward like a polite macro trade. It exploded into new territory, record territory, printing levels that psychologically change behavior. Because once you push into the 70s and flirt with the high 70s, you are not in a normal commodity tape anymore. You're in a regime where producers rehedge, consumers pull forward orders, speculators get punished for fading, and dealers start thinking in terms of risk limits instead of opinions. And the faster it happens, the more it matters. Speed is a signal. A slow climb invites balanced positioning. A vertical move creates imbalance, and imbalance creates forced decisions. Now, the obvious explanation making the rounds is the simple one. Rate cuts are coming, the dollar is weaker, so precious metals are up. Fine, that's one layer. But it's not the layer that explains why silver is behaving like it, sniffing a constraint. Because here's the uncomfortable truth. Even if you believe rate cuts are coming, the market can still whipsaw violently. The dollar can bounce. Real yields can spike for a week. Risk assets can wobble. And yet, silver still moved like the market was paying for immediacy, not just for a story. That's the pivot. That's the hidden detail. The price you see on a screen is the headline. The structure around that price is the confession. And in metal, structure means which month is being bid, how the curve is shaped, whether nearby delivery is being paid up relative to later settlement, whether spreads behave like inventory is comfortable or like inventory is stressed, whether financing and borrowing costs for real metal start acting strange, whether you see paper supply expand easily, or whether it feels like the market is squeezing through a smaller pipe. You don't need to memorize jargon for this. Just think like a procurement manager. If you have no urgency, you buy later, and you demand a discount for storage and financing. If you have urgency, if you need metal now, you pay up to secure it. That urgency shows up in the curve. It shows up in spreads. It shows up in premiums. And when that urgency appears at the same time as a macro regime wobble, you get exactly what we're seeing. Silver not just rising, but declaring that time is now an input in price. And that's not the part that gets discussed on cable TV. But that's the part that flips the whole setup. Now, connect this to the Fed trap. The Fed can talk all it wants, but markets clear through collateral and funding. When the central bank signals easing, even a cautious easing, the market immediately asks, easing because inflation is truly falling, or easing because something is under strain? And if the market suspects the second, it starts to hedge currency and liquidity risk simultaneously. That's where silver becomes more than an inflation trade. It becomes an insurance trade that also has industrial scarcity optionality. And that optionality is why silver can move in violent bursts, because the same bar of silver can represent hedge the currency to one buyer and secure the input to another buyer. Two different bids, one market, limited elasticity. This is where supply chain reality matters. Silver is not like oil where you can crank a spigot quickly. A big chunk of silver supply is tied to byproduct production, mined alongside other metals, so you don't have to just produce more silver because the price went up last Tuesday. You need investment, permitting, processing capacity, refining throughput, and time. Recycling helps at the margin, but it doesn't respond instantly to a spike when the world wants to hoard. Logistics takes time. Refining takes time. The supply response is slower than the price response, and that lag is what creates squeezes. And once a squeeze begins, it feeds itself because higher price increases perceived scarcity, which increases hoarding, which reduces available float, which increases sensitivity to any marginal demand. Reflexivity. That's the word, even if nobody wants to say it out loud. But that's what it is. And the next detail is what makes it so relevant today, and not just as a long-term thesis, the calendar. The calendar is the catalyst. Year-end is not just a date on a wall, it's a forced behavior machine. Funds rebalance, dealers clean books. Risk managers tighten limits. Liquidity thins, spreads can widen. And thin liquidity is where a metal like silver becomes dangerous in both directions. Dangerous for shorts because there isn't teak enough depth to absorb covering, and dangerous for late longs because the market can weaponize volatility to shake them out. If you've ever watched silver, you know it doesn't like to reward the crowd. It likes to punish certainty. It will rip higher, then knife down, then rip higher again, because it's a smaller market with a future structure that can amplify positioning errors. So the why now isn't just macro. It's microstructure meeting year-end mechanics, and that's why you have to think in flows, not feelings. Here's the mechanism that turns a rally into a launch: futures and options positioning. Start simple. A futures market is leveraged by design. You control a lot of notional with a small amount of margin. That means when price moves fast, margin calls and risk limits start deciding who gets to hold positions. When price goes up hard, shorts face losses, and if they're not hedged or capitalized, they don't get to wait. They have to cover. Covering is buying. Buying into a rising market is fuel. Now add options. Options are not just lottery tickets, they are hedging instruments. Dealers who sell calls to traders often hedge their exposure by buying futures as price rises, delta hedging. In certain zones, that hedging can become reflexive. Price rises, delta increases, dealers buy more futures, which pushes price higher, which increases delta again. That's a feedback loop. It's not magic, it's mechanical. And when liquidity is thin, that loop can shove price through levels that would normally hold. This is why a line break matters. It's not that charts are mystical. It's that many strategies and risk systems anchor on the same levels. Once breached, stops trigger, hedges adjust, and the market becomes a cascade of must-do trades rather than want-to trades. And that's where the real pressure starts. Now, the proof stack. You should never hang your thesis on one argument. In markets, you stack signals until the weight is hard to ignore. Signal 1, price itself and the speed of the move. A surge into record territory tells you demand isn't politely balanced by supply. It tells you marginal buyers are willing to chase. Signal 2, the macro backdrop. The Fed has already signaled a softer stance relative to earlier tightness, and the market is leaning into the idea that rates will be lower over time. Whether that is for good reasons or bad reasons, lower expected policy rates tend to loosen the grip that real yields have on non-yielding assets. But here's the twist. Silver moved even as the market still wrestles with whether inflation is truly conquered. That suggests the bid isn't just a clean real yields down trade. It suggests risk hedging is creeping back in. Signal 3, the dollar context. The dollar has been weak, and even if it gets a technical bounce, a weaker dollar environment generally increases the appeal of hard assets to global buyers and can change trade flows. But the fact that silver can surge even with the market discussing a dollar rebound risk tells you the buying isn't on purely currency tourism. Something else is pushing. Signal 4, industrial demand. This is not a meme. Silver is used across electronics, solar, medical applications, and the expanding infrastructure behind data centers and electrification. You Donati have to believe every headline to accept the direction. More electrification and more compute intensity tends to increase demand for conductive materials. When that demand meets an inelastic supply response, the market gets jumpy. Signal 5, supply constraints and pull forward behavior. When there's chatter about export controls, trade restrictions or bottlenecks, whether from major producing regions or key processing links, industrial buyers don't wait for confirmation. They hedge by securing inventory. They buy earlier than they otherwise would. That behavior itself creates the tightness it fears. And in silver, it doesn't take a massive percentage shift to matter because the market is smaller than people assume. Signal 6, inventory stress signals. the hidden detail. Even when headlines talk about spot prices, the market often reveals its real condition in how it values time and deliverability. When nearby contracts act unusually strong relative to later months, when the cost of borrowing metal rises, when spreads behave as if available now is scarce, that's a tell. It doesn't require a conspiracy, it requires incentives. If dealers and users need metal in specific locations on specific dates, they pay up for immediacy and hedge the risk of being short physical in a rising market. That can produce backwardation-like behavior or abnormal spread moves. Again, not magic. A scarcity of deliverable float in the right place at the right time is enough. Signal 7, institutional and retail behavior. When silver becomes too expensive, gold becomes too expensive, investors look for the next liquid hard asset that still feels accessible, and silver becomes the on-ramp. That flow can be captured through ETFs and other vehicles, and when it accelerates, it can tighten the pool further, especially in a year-end window when liquidity and inventory availability is already more sensitive. None of these signals alone guarantees continuation, but stacked together, they explain why silver ES move can prove a trap. The market is acting as if policy choices are narrowing, and it is pricing the side effects before the Fed can. Because if the Fed stays tight, stress rises in funding-sensitive parts of the economy and markets, which increases hedging demand and volatility. If the Fed eases, currency hedging demand rises, and the hard asset bid strengthens. That's the trap. And silver is the canary that also happens to be an industrial workhorse. But that's not the part that matters most for you, the viewer, the retail investor with fragile attention and a healthy skepticism. What matters is what happens next and how you avoid being used by the volatility. Because silver's greatest talent is not trending. Its greatest talent is humiliating people who confuse noise for signal. Here's your psychology shield, and it's simple. Expect violence and refuse to interpret every candle as a verdict on your intelligence. In silver, even a bullish thesis can include a brutal pullback that feels like the end of the world. That pullback exists because the market needs to reset positioning, harvest stops, and reprice leverage. If you buy because you feel the move and you size like you're right, silver will teach you a lesson. The market doesn't care about your conviction. It cares about your margin. And silver is a margin-based market. So the rule is separate trend signal from noise. Trend signal is the market holding reclaimed levels and building higher lows over days and weeks. Noise is the intraday whip that exists to transfer metal and contracts from weak hands to strong hands. And your job is not to win every wiggle. Your job is to stay solvent and aligned with the higher probability path. And that's where risk framing matters. Price can whip around violently even if the thesis is correct. That sentence alone can save you money. The market can make you right and still destroy you if you've been over-levered or emotionally rigid. And if you want to be in the game long enough to benefit from the big move, you must behave like someone who expects the market to attack your psychology. Because it will. It will tempt you with a vertical candle, then punish you with a sudden flush, then lure you back with a rebound, then flush again. That's the business model. And you can opt out of being the victim by using a two-scenario lens. Here it is. Scenario 1 is the controlled pullback and retest. Silver, after ripping into record territory, cools off. It retraces. It tests the breakout zone. It shakes out late longs. It gives the market time to rebuild liquidity and reposition. This is the healthy path. In this scenario, you watch whether prior resistance becomes support. You watch whether dips are bought quickly or whether they sag and stay heavy. You watch whether the market can hold above psychologically important round numbers. Think the $70 area as a line in the sand for the new regime, and the mid-70s as the zone that decides whether momentum stays alive. If silver can pull back, retest, and hold, especially into thin liquidity windows or earlier positioning, then the move is not just a blow-off. It becomes a base for continuation. And that's where the real pressure starts, because a held retest forces funds and hedgers who missed the move to buy dips instead of fading rallies. Scenario 2 is the continuation squeeze and gap risk. This is the no mercy path. Silver doesn't give a clean retest. It consolidates briefly, then rips again, pushing toward and through the next psychological ceiling. Think $80 as the headline magnet, with the market trying to print it decisively. In this scenario, liquidity becomes your enemy. Gaps can appear, spreads can widen, stop runs can be violent, and if you're short, you're not short a chart. You're short a machine that can force you to buy at the worst possible moment. This path is often driven by a combination of short covering, dealer hedging, and procurement urgency. And the tell here is not your feelings. The tell is behavior. Do pullbacks get instantly bought? Do rallies close near highs? Does the market refuse to spend time below key levels? Do you see strong strength in nearby contracts relative to later ones, implying immediacy demand? Do you see volatility rising alongside price, indicating a stressed chase rather than a gentle bid? Those are the clues. And if that's the setup, the market can overshoot what seems reasonable. because reasonable is not a pricing input during a squeeze. Forced behavior is. Now, what would weaken or invalidate the thesis? Because a credible bullish case must include the conditions for being wrong. First, a meaningful and sustained rebound in the dollar can pressure metals, especially if it coincides with a repricing higher in real yields. A dollar bounce alone doesn't kill the move, but a dollar bounce plus higher real yields plus easing of supply stress can. Second, if the curve structure relaxes, if time value returns, spreads normalize, and signs of immediacy tightness fade, then the hidden detail that supported the plumbing stress narrative weakens. Third, if industrial demand expectations get hit, say a sharp risk-off that signals demand destruction rather than hedging demand, silver can get caught because it is not pure safe haven. It has a foot in the factory. That is both the upside and the risk. Fourth, a blow-off pattern. If silver goes vertical without pauses and then fails to hold any reclaimed level, if it collapses back under major breakout zones and stays there, that suggests the move was dominated by short-term leverage rather than lasting demand. And in silver, leverage can unwind brutally, so you do not marry the thesis. You date it. You require confirmation. And that confirmation is always the same in structure terms. Hold the breakout zone, defend key levels, and show that dips are bought with urgency. Now let's talk about the Fed trap again, but in a way that matters for next week, not for a textbook. The Fed is trapped because it is trying to manage expectations in a world where the consequences of policy are immediate and global. When the Fed cuts or signals a path to cuts, it's not just a domestic story, it's a global signal about the dollar, about funding, about risk appetite, and about the price of protection. And when the world believes the dollar AS purchasing power is being managed by a committee that also must prevent a recession and prevent a financial accident, the world hedges. That hedging shows up in gold, but when the hedging intersects with real supply chain constraints, it shows up in silver with more volatility. Because silver is smaller, more sensitive, and more reflexive. It's the kind of market where you can't hide big flows easily, and the calendar amplifies that. Year-end flows are not a polite debate. They're a deadline. Dealers don't care about your macro thesis. They care about what their book looks like at the close. Funds don't care about your conviction. They care about benchmarks and risk budgets. Industrial buyers don't care about narratives. They care about not shutting down a line because an input isn't available. And when all of those actors hit the same calendar window, you get stress. That's why this move matters today. It's not just the price, it's the timing. It is the fact that the move is forcing behavior right when behavior is already forced by the calendar. And that is why you should expect volatility to be used against you. This is not moral judgment. It's market reality. Volatility is a tool. It shakes out leveraged longs. It punishes late entrants. It creates liquidity for larger players. And it tricks the human brain into reacting to short-term pain as if it is long-term danger. Your brain is wired to survive, not to trade. So your shield is to pre-commit. Pre-commit to your time horizon. Pre-commit to your sizing. Pre-commit to what would change your mind. If you don't, silver will make those decisions for you in the worst possible moment. And that's where most people lose, not because they were wrong about direction, but because they were wrong about volatility. Now, the hidden detail again, because I want it burned into your memory. In metals, the real stress often appears first in the cost of time. When the market values immediate metal disproportionately, it tells you something about availability and urgency. You might see it as unusual strength in nearby contracts, unusual spread behavior, or borrowing dynamics that get tight. You don't need the exact numbers to respect the phenomenon. You just need to understand the mechanism. The paper market can create synthetic exposure, but it cannot conjure deliverable inventory in the right place at the right time. And when deliverability becomes the constraint, the price stops being a smooth reflection of fair value and starts being a clearing price for urgency. That's when silver gets wild. That's when headlines chase the move after the move has already happened. And that's why the market can't unsee it once the line breaks. So what do you watch next practically in the next week or two? You watch three things: levels, structure, and catalysts. Levels first. Round numbers matter because humans and risk systems anchor there. $70 is a psychological threshold that now acts like a referendum. Above it, the new regime is alive. Below it, the market may be entering a deeper retest. $75 is a zone of momentum. If silver holds above it on pullbacks, it signals a strong bid. $80 is the magnet in the headline. If the market tags it and holds near it, it signals that the squeeze path is in play. If the market tags it and violently rejects, it signals blow-off risk and the potential for a deeper reset. Structure second. Watch whether pullbacks are shallow and fast or deep and grinding. A shallow, fast pullback that gets bought is bullish behavior. A deep, grinding pullback that can't reclaim levels is distribution. Watch whether the market closes strong or weak. In squeezes, closes matter because they affect hedging and risk management. Watch whether volatility rises and stays high. Sometimes rising volatility with rising price is a sign of stress chasing, which can extend, but it also raises the risk of sudden reversals. Catalysts third. The calendar isn't done with you. Early year repositioning can be violent. Options positioning can reset. Delivery windows can create localized tightness. Policy messaging can shift tone quickly if data surprises. And geopolitical headlines can trigger risk hedging. You don't need to predict every catalyst. You need to know that catalysts are the sparks, not the fuel. The fuel is positioning and structure. And if you're watching the fuel, you'll understand why the spark matters. Now here's the paradox. If this is truly a Fed trap signal, then the market is telling you volatility is the baseline, not the exception. That means you should stop asking for certainty and start asking for asymmetric setups. Where do you have a clear invalidation? Where do you have a clear confirmation? Where can you survive being early? Because in silver, being early can feel like being wrong. The market can punish you before it rewards you. That's why the most dangerous thing you can do is confuse excitement with edge. Excitement is what the market sells you at highs. Edge is what you build with structure and discipline. And if you're the kind of viewer who refuses to be a tourist, if you want to treat this like a professional, then your identity is in Tees, Bull, or McBear. Your identity is risk manager. You don't need to predict the next tick. You need to know what would make the thesis stronger and what would make it weaker. Stronger, silver holds above key reclaimed levels on pullbacks. Strength persists into the next calendar window. And any structural signals of tightness or immediacy demand remain elevated or reappear when price dips. Weaker, silver fails to hold the breakout zone. The dollar and real yields reassert pressure in a sustained way, and the move looks like a leveraged blow-off that can't build a base. That's the game. And here's the final point, the one that ties everything together. The Fed being trapped doesn't mean the Fed has no power. It means the Fed's power is increasingly expressed through volatility rather than through smooth guidance. Markets are calling the bluff of control, and silver, because it sits at the intersection of currency hedging, industrial demand, and physical constraint, has a habit of telling the truth before the speeches do. That doesn't mean it goes up in a straight line. It means it becomes the arena where the consequences of policy get priced in real time. So if you want the clean takeaway, it's this. Treat silver's move as a message about the regime, not just about the metal. Watch the levels like a map. Watch the structure like a lie detector. Respect the calendar like a weapon. And don't let volatility steal your decision-making. If you made it this far, you're not here for comfort. You're here for clarity. Drop a comment with the one level you think matters most. $70, $75, or $80, and why? Because the fastest way to get sharper is to compare frameworks with people who think in mechanisms, not memes. And if you want more of these market structure breakdowns, where we separate headline stories from the plumbing that actually moves price, stay with this channel because the next 2 weeks are exactly where traps get sprung and the crowd gets emotionally harvested. And that's where the real pressure starts.